how did it get into how did the investment bankers actually implement this strategy? Well, they had a number of pretty esoteric instruments like CDOs and SIVs and CDO squares, and just kind of give you a flavor for those instruments. A CDO is actually, it's called a credit default obligation. It's actually a legitimate idea. And the way the idea got started, a bank makes a $500 million loan to General Electric. Even though General Electric's low risk, they don't want to have that concentration, so they sell $400 million of the loan into the capital markets to diversify the risk. A legitimate idea. The investment bankers took that idea and perverted it in a certain way. They started looking at these securitized home mortgages, and maybe they had a book of home mortgages that were, and I'm going to try to make it simple, were rated B from a risk perspective. They knew in the capital markets there were some people that would like to buy A's, which are lower risk but also lower years, and some people that like to buy C's, which are higher yields and higher risk. They said, well, what if we can take these B's and we can make them into A, B's, and C's, and we'll find more buyers and we'll make more profit selling these. So they went in and they did something called truncating. They said, okay, we're going to have 3 tranches out of these B products, and the first tranche we'll call the C tranche, and it'll take all the first losses. Then the next losses will go to the B, and finally the losses will go to the A. And in theory, C and B will take all the losses, so you never could have any risk with B. And then an interesting thing happened, and that is that Bernanke inverted the yield curve. So the investment banks have been making a lot of money selling A, B's, and C's, but they had nothing to hold in their own portfolio, and the only asset they could hold that had a positive spread, because Bernanke had inverted the yield curve, with the C's. Well, the Fed was projecting the economy is going to do great, so they said, why don't we just hold these C's, because they got the high yields and we'll sell them in the future. Well, the problem with that was twofold. One is that the A, B's, and C's weren't A, B's, and C's. They were D minuses, F, and F minuses. So when the market started coming down, there were 100% losses on these C's. Tremendous losses on these C's. So if you really look at, like, Merrill Lynch was making a fortune a year before they went broke, and that's because they were selling the A's and B's and they were holding the C's, but they took terrific losses in the C's that they had portfolioed. Credit default swaps. Credit default swaps is also actually a fairly interesting idea. A credit default swap is really just an insurance policy primarily issued by AIG, the largest insurance company in the world. And the way that worked, maybe Goldman Sachs has a portfolio of B-rated mortgages. They wanted to get them to A-rated because they could hold less capital when they're A-rated. So they would go to AIG and say, give us an insurance policy, and these Bs will become A's, because AIG was AAA rated by Standard & Poor's, Moody's, and Fitch. Okay, all that sounds good, except a couple things happened. First, the ratings from Standard & Poor's, Moody's, and Fitch were wrong. These mortgages weren't really Bs, they were really D minuses. And then AIG's own models were defective. They missed in rating these instruments. So the losses were much bigger than they projected. Also, by the way, AIG got caught with fair value accounting. Remember that example I said earlier where you had $100 million worth of mortgages that economically were worth $80 million? AIG should have had to have a $20 million hit on that if they were insuring those mortgages. But under fair value accounting, they had to take a $50 million hit because of panic in the marketplace. So they took much bigger losses than you would have expected based on the accounting system. One of the interesting questions is, should we have saved AIG? It's a very interesting question because if you look at AIG's insurance subsidiaries, they were very important to the economy, but they were totally well capitalized. The issue was in the AIG parent company. The AIG parent company, in theory, could have gone broke and nobody had missed them, to tell you the truth, except for the counterparties. The biggest counterparty to AIG was Goldman Sachs. Well, Hank Paulson and everybody at the U.S. Treasury came out of Goldman Sachs. If you spent your life at Goldman Sachs, you can honestly believe that if Goldman Sachs gets in trouble, it's going to take out the U.S. financial system. So the issue was that really systems risk or crony capitalism. Make your own judgment. All right, one of the big myths is that the banking industry was deregulated. We were not deregulated, we were misregulated. In fact, the regulatory environment during the peak of the bubble was the worst in my almost 40-year career in the banking business. It was interesting where the regulations were focused. They were focused on Sarbanes-Oxley in the Patriot Act. Sarbanes-Oxley was supposed to eliminate fraud around the World Common Enron events. The banking industry had a Sarbanes-Oxley back in 1990 in relation to the thrift crisis, so it was a redundant system on a redundant system. The Patriot Act was supposed to keep us to enable us to capture terrorists. Interestingly enough, the banking industry spends about $5 billion on the Patriot Act. You know how many terrorists have been captured because of the Patriot Act? None. You know how many terrorists are likely to be captured by the Patriot Act? Not many. I'd say none. What's the odds of one of our tellers catching a terrorist? And if we caught one, you think we would call in anyway? In addition, there was a very strong regulatory belief in what's called mathematical modeling. In fact, we were under an intense pressure that if we just had mathematical models like Wachovia that failed or like Citigroup that failed, we'd have great management of our risk. Interesting thing related to mathematical models is what happened internationally. If you may remember when this crisis started, it started in the U.S. and for 3 or 4 weeks kind of the Europeans were laughing at us, and then all of a sudden almost all the European banks got under severe stress and had to be bailed out by their governments. And the reason for that was an international agreement called Basel, which uses mathematical models to determine how much capital banks hold. Well, the U.S. fortunately hadn't fully implemented Basel, but the Europeans had. And under the European model, using Basel, using mathematical modeling, they had a lot less capital, so they went down much, much faster than the U.S. banks did. There's certainly legitimacy in mathematical modeling, but mathematical modeling has a couple problems. One of them, we'll call it the tail problem. Normal assumption is that we have what's called a normal curve of probabilities, and the tails are supposed to have very small probabilities. Well, if you're doing mathematical modeling, you're hugely motivated to create a model that shows a very small probability in the tail. So usually the risk in the tails is much bigger in reality than people expect. The other thing about these tails, even if they only have 1% probability, something I tell people, if you build a house in a 100-year floodplain, the bad news is you are going to have a flood. It's just a matter of when. The other thing about these mathematical models is no mathematical models can really capture human behavior under stress. So all the mathematical models failed, including all the Federal Reserve model. Remember, the Fed did not forecast even a recession, much less a recession of this magnitude. One thing you need to understand is this regulatory pressure had a huge impact on management actions. It wasn't just the money, but under Sarbanes-Oxley and under the Patriot Act, executives can go to jail. When they threaten to put you in jail, that is going to impact your behavior. Another great myth is that the regulators are trying to encourage banks to make more loans. That's what, they want us to make more loans. Not so. Maybe the people at the top want to make more loans, but not the actual bank examiners. You got a perverse incentive system. If you're a local bank examiner, the only thing that can be bad for you is for your bank to get in trouble. And so you have a huge incentive to be extremely conservative. Bank examiners are flooding all the banks in the U.S., including the very healthy banks, and tightening credit standards. BB&T is not making loans that we think we ought to make, and we're putting people out of business that we'd rather not put out of business because of the regulatory pressure. And so the bank examiners are actually reducing lending, not incenting lending. We talked about the SEC, the Securities and Exchange Commission. I just want to focus on one area that we hadn't highlighted so far. That's loan loss reserves. Traditionally, banks have maintained reserves against loan losses. And in the past, those reserves were partly subjective. And the old saying was you make your bad loans in good times. So in good times, you're making money, so you build up your reserves in the good times. The SEC made it impossible to do that. Based on mathematical modeling, they forced banks to go to mathematical models for loan loss reserving. And those models had two basic characteristics. One, they looked back at past experience. And remember, we hadn't had a serious economic correction since 1990. So past experience, banks were taking very low loan losses. And then secondly, they said, we'll use mathematical models of the economy, and all the economic forecasters, both the Federal Reserve and the private forecasters, were not projecting a recession. So based on both looking back and looking forward, using mathematical models, banks had very low loan loss reserves going into this crisis. A lot of the initial losses in the industry were simply banks raising reserves that they would have had if they hadn't been for the SEC.